Something quietly happened to car insurance in America, and most people have absolutely no idea it happened. They are still paying rates from 2 years ago, rates that were jacked up after the pandemic when insurance companies decided to charge everyone more for the reckless driving of a minority. They are overpaying every single month, and the insurance companies are not exactly rushing to send anyone a letter about it. Here is what actually happened. After years of brutal rate increases, we are talking a 46% jump between 2022 and 2024. Insurance rates finally started dropping, 6% down in 2025. And right now in 2026, they are holding flat, which sounds boring until you realize what that actually means for the average American driver. It means you might be sitting on a refund you did not know existed. It means your neighbor who switched providers last month is probably paying less than you right now for the exact same coverage. And it means if you have not looked at your car insurance in the last 12 months, you are almost certainly leaving money on the table, real money. We are talking hundreds of dollars a year, for some people thousands. So today we are getting into it. No insurance company jargon, no confusing fine print, just exactly what changed, exactly why it matters, and exactly what steps you can take this week to make sure you are not the person still paying 2023 prices in 2026. Let us go. Part 1. What actually happened and why. To understand where we are right now, you have to understand where we came from. During 2020 and 2021, something strange happened on American roads. Lockdowns emptied the highways, and a certain group of drivers, not everyone, but enough to matter, used those empty roads to drive like absolute maniacs. Speeds went up, accidents went up, insurance claims went up, and insurance companies, looking at all that data, made a decision. They were going to raise rates across the board for everyone, even the drivers who never touched another car in their lives. By 2023, the average American was paying 14% more for car insurance than the year before. That is not a small number on top of everything else that was getting more expensive at the time, and it kept going. 2024 was another painful year. The average annual car insurance premium crossed $2,000 for the first time for many American drivers. Then something shifted. By 2025, the insurance companies had made their money back. Their reserves were healthy again. Competition between providers started heating up, and rates started coming down. Not dramatically, but meaningfully, 6% on average in 2025. And heading into 2026, the expectation was for rates to hold steady, with some providers actually cutting rates further to grab market share from competitors. Here is the part that should make every American driver sit up straight. The companies that cut rates are not automatically passing those savings to their existing customers. They are using the lower rates as a marketing tool, advertising them to people who are actively shopping around. If you are sitting on your couch assuming your insurance company gave you the best rate, you are probably wrong. Part 2. How much are Americans actually overpaying? Let me give you some real numbers because this is where it gets eye-opening. The average American currently pays around $2,100 per year for car insurance. That is for a single vehicle. If you have 2 cars in your household, which most American families do, you are looking at over $4,000 a year just to keep your vehicles legal on the road. Now here is where the gap opens up. Studies on insurance shopping consistently show that Americans who have not compared rates in the last 12 months are on average overpaying by somewhere between $300 and $900 per year. Some drivers, particularly those who had an accident or ticket a few years ago that has now dropped off their record, are overpaying by even more because their current insurer may still be factoring in old risk factors that should no longer apply. $300 to $900 a year sounds abstract until you think about what that money could actually do. That is a car payment. That is a family vacation. That is months of groceries. That is money sitting in an insurance company's bank account that belongs in yours. Part 3. 5 things that are secretly raising your rate right now. Here is where most people get surprised. Because your insurance rate is not just about your driving. There are factors affecting what you pay right now that have nothing to do with how safely you drive. Your credit score, In most American states, your credit score directly impacts your car insurance rate. Drivers with lower credit scores pay significantly more, sometimes hundreds of dollars more per year, than drivers with identical driving records who simply have better credit. If your credit score has improved in the last year and you have not told your insurance company, they do not care. They will keep charging you the old rate until you make them recalculate. Your zip code. Insurance companies price risk by neighborhood. If you moved in the last year, plus even across town, your rate should have changed. If it did not go down when it should have, you need to call and ask why. Your vehicle's age. The older your car gets, the less sense it makes to carry full comprehensive and collision coverage. An 8-year-old car worth $6,000 with $500 annual collision coverage is a questionable financial decision. Yet millions of Americans are still carrying coverage levels that made sense when their car was new and worth 3 times as much. Loyalty pricing. Here is the counterintuitive one. Being a long-term customer with the same insurance company often means you are paying more than a brand new customer. Insurance companies offer introductory rates to attract new business. The longer you stay without shopping around, the more you drift toward the higher standard rate. Loyalty should be rewarded. In the car insurance world, it often is not. Bundling discounts you never claimed. If you have homeowners or renters insurance with a different company than your car insurance, you are almost certainly leaving a bundling discount on the table. Most major providers offer 10 to 20% off when you combine policies. That is a guaranteed discount most Americans never think to ask about. Part 4. Exactly what to do this week. Here is your action plan. Specific steps. No vague advice. Step 1. Pull out your current insurance documents. Know your coverage levels, your deductibles, and your annual premium. You cannot negotiate what you do not understand. Step 2. Check your driving record. You can do this free through your state's DMV website. If tickets or accidents from 3 or more years ago are still on your record, they should be aging off depending on your state. Know exactly what is on there before you shop. Step 3. Check your credit score. If it has improved significantly in the last year, note that. It is a negotiating tool with your current provider and a factor that new providers will use to offer you a better rate. Step 4. Get quotes from at least 3 different providers. Do this online. It takes about 20 minutes per quote. Use comparison tools like the Zebra, Insurify, or simply go direct to the websites of the top 5 insurers in your state. Do not accept the first number you see. Step 5. Call your current provider with the best competing quote you found. Tell them you have a lower offer and you would like them to match it or explain why your rate is higher. Insurance companies have retention departments specifically for this conversation. More often than you would expect, they find a way to lower your rate rather than lose your business. Step 6. If they cannot match it, switch. Switching car insurance is not complicated, and it does not affect your credit score. You can switch mid-policy and get a prorated refund on your current premium. There is no loyalty reward for staying with a company that is overcharging you. Final thoughts. Here is the bottom line on all of this. Car insurance in America is not a fixed cost. It is a negotiable expense that responds to your driving record, your credit, your vehicle, your location, and most importantly, your willingness to shop around. The Americans paying the least are not necessarily the safest drivers. They are the most informed ones, the ones who treat their insurance like what it actually is, a recurring bill that should be reviewed and challenged regularly. You now have exactly what you need to review yours. The rates are favorable right now. The competition between providers is real, and the savings are sitting there waiting for the people who bother to look. Do not be the person still paying 2023 prices in 2026. If this video opened your eyes, hit the like button right now. Subscribe to AmericanRevHead because this is exactly the kind of content we bring you every single week. Real information about the real cost of owning a car in America, with zero fluff and zero dealership bias. Drop a comment below and tell us, when did you last check your car insurance rate? The answer might surprise you. Until next time, drive smart, spend smarter, and never pay $1 more than you have to.